it's really a privilege to have Jordan here today to talk with us. He's the Executive Director and Global Market Strategist at J.P. Morgan Asset Management. You're part of the Global Market Insight Strategy team, where you deliver timely market and economic commentary to clients nationwide. You were doing that this morning somewhere out in Houston for a luncheon. We weren't able to make it. At the Houston Racquet Club. He's a frequent guest on Bloomberg, CNBC, Yahoo Finance, and now the New Capital Annual Conference. Congratulations, you made the big time. You've authored numerous papers on the economy and markets, focusing on fixed income and monetary policy, which we're going to do today, and contributions to key publications like the Guide to the Markets, which we use so heavily for production of our graphs that we show to you. Since joining J.P. Morgan in 2015, Jordan has served in roles including the Global Consultant Strategy Group in New York, supporting institutional asset management consultants. You hold a BA in African American Studies from the University of Virginia and a Series 7 and 63 licenses. And we met the first time, it's been a few months, you came to the office, and we have republished several of Jordan's pieces along the way for our journal. Daisy was talking about the journal, and a number of you read our monthly journal, and we review the stuff that's on offer from J.P. Morgan, and each time I was like, I like that thing from Jordan Jackson. And the next month I was like, I like that thing from Jordan Jackson. I like that. And so it was just over and over. I really like this writing. It's short, it's pithy, it's impactful. And then we got a call. Jordan Jackson would like to come visit us he's in town at New Capital Management. I was like, yep. And so one thing has led to another. Welcome. It's great to have you today.
Thank you so much.
Oh, you're wired up.
Wired up.
Thank you very much.
Thank you so much, Leonard. I'm so excited to be here. Flew in from New York, so I think I brought in some of the cooler weather with me. But really appreciate the time. Again, really excited to be here, and thank you, Leonard and team, for the opportunity to speak with you all. So as Leonard mentioned, I've been with J.P. Morgan for a little over 10 years now, working on our market insights team. Our focus on the team is two things: to try to simplify the complex and see the present with clarity. And the way we do that is we put together this roughly 65-page chart pack that covers everything from equity markets to international markets to fixed income to alternative asset classes. And my area of focus tends to be around bonds and fixed income. So I lead the research agenda for our fixed income research for our broader team. We are a global team. We have about 30 strategists across the world. So we have teams based across Germany, strategists in France, Spain, folks in Asia, whether it be Taiwan, Hong Kong, Beijing. And we meet every Monday morning at 9 a.m. Eastern Time to talk about what's going on in the world. And it is so valuable to have boots on the ground across the world to get a sense of what's really going on in many of these domestic markets and local regions. So I'm going to spend a little bit of time talking about bonds, my area of focus, and around sort of the effects of fiscal, so federal spending. I'll maybe make some comments around Social Security because that came up as well. And then also talk about monetary policy. We just 20 minutes ago got an announcement from the Federal Reserve that they cut interest rates by another 1/4 percentage point, which is their second cut so far this year, and a continuation of rate cuts starting in September of last year. So what does this mean? What is the impact that's going to have on the bond market, on fixed income? I think while we have seen mortgage rates come down as of this morning, mortgage rates are at their low that they've been since September of 2024. But just because the Fed is cutting rates, that doesn't necessarily mean that mortgage rates will continue to come down. So we'll talk a little about our expectation for mortgage rates and broader rates as well. And then I love intimate sessions like this, so please feel free to raise your hand, ask questions, and I'll address those along the way. I did want to first start off to talk a little bit about trade and tariffs, because this is obviously having an impact on broader market sentiment and on broader business activity and business uncertainty. So this chart here just looks at the average effective tariff rate on U.S. goods coming into the United States. And the reason why I wanted to start off with tariffs is because obviously we've seen a big increase in tariff rates. Last year, the average tariff rate was right around 2.5%. Our current estimate is tariff rates now sit at about 17%. And this is translated, as we think about fiscal policy, to a sizable increase in overall tariff revenues and duties that have been collected at the ports. So we just closed the book on fiscal year 2025. The government's fiscal year runs from October 1st to September 30th. Last year, for fiscal year 2025, the U.S. government collected $195 billion in tariff revenue. That's a 250% increase in tariff revenues relative to fiscal year 2024. So that's a significant jump higher. And clearly the administration's focus on reasoning behind tariffs is to be a primary source of revenue for the government. A very similar dynamic, this chart actually goes back to the early 1900s, a similar dynamic back in the early 1900s where most of the American workforce was on a farm, and agriculture was the primary sort of source of employment for the U.S. So there's been a big shift, a big boost in overall all tariff revenues. Even with the increase in overall tariff revenues for fiscal year 2025, we still had a deficit as a percent of GDP of 6%. And we're projected to continue to run a deficit, even including tariff revenues over the next decade, deficits continuing to run between 6 to 7% of GDP. Now, as we continue to borrow more than we bring in overall tax revenues, that's going to continue to worsen our overall debt levels. So debt is expected to continue to rise. Right now, it's currently at about 97% of debt to GDP, and we're expected to rise over the next 10 years to 115% of debt to GDP. And this is including the tariff revenues. Now, the reason being I mentioned all this around deficits and debt levels because this directly translates to interest rates. And we're going to spend some time talking about interest rates as well. If we're borrowing more, that means we have to issue more Treasury bonds into the market. And if we have to issue more Treasury bonds into the market, that could potentially put upward pressure on interest rates. That ties into things like credit card APRs, the loan that you're able to take out on your auto loans, mortgage rates, right? There's this long-term potential for these rates to actually move higher as we continue as a government to borrow beyond our means. And while we do think the implications of the big, beautiful bill are going to be moderately stimulative for the economy in the first half of 2026, again, the impact of deficits and debt levels, we're on an unsustainable trajectory. Now, the big, beautiful bill, as I mentioned, we do think it is going to be moderately stimulative for growth in the first half of 2026. Why is that the case? Well, if you think about some of the components on the consumer side, the removal of federal income tax on things like tips and overtime pay, the removal of or the reduction in the overall corporate tax rate. There wasn't a reduction in the corporate tax rate, but the ability to expense our domestic R&D, accumulated depreciation, all that could very well bring a bit of a boost to CapEx, the way companies spend and invest. And then when you think about the consumers, again, things like the increase in the overall state and local tax deduction from $10,000 up to $40,000. That's also going to be moderately stimulative as well. The bonus depreciation for those individuals 65 and older. You know, suffice it to say, many Americans are going to receive a larger refund check in March, April, and May of next year than they did last year. And we know you give an American consumer $1, they're going to find a way to spend $2. And if you're my wife, you're going to find a way to spend $3. So that's going to be a bit of a boost for broader consumption dynamics. That's going to be a bit of a boost towards economic growth. But again, it doesn't necessarily change the long-term implications where we're, again, still expected to see higher deficits and higher debt levels. And that could potentially feed through into higher interest rates as we continue to borrow beyond our means. Now, there's a lot of concerns around Social Security. And so, but I think we need to make sure we kind of understand how the Social Security and the OSAI trust fund actually works. So when you hear statements and headlines that say, we're going to run out of money in Social Security by 2033, that's not accurate. Essentially what is going to happen is, if you think about the period from the 1980s to the 1990s to the 2010s, payrolls, so what, when we receive a paycheck and we pay into Social Security, payrolls were outpacing benefits. So we had more money coming into Social Security than was actually being taken out by retirees for that roughly 40, 50-year period. Now what we're seeing happening is no longer are payrolls, what's being paid into Social Security is being enough to pay out benefits. Now, when we were in that surplus, so there was more money coming into the trust fund than coming out of the trust fund, that money was being invested into Treasury securities, essentially an IOU from the federal government. That was generating interest, right? What's going to happen in October or in 2033 is we're going to have sold off all of those Treasury investments that we made. That surplus, those buffer assets, if you will, are going to have run out by 2033. But importantly, there's still going to be money coming into the pot. People are still going to be paying payroll taxes and Social Security coming from payroll. And so what's going to happen in 2033 is that those individuals who are receiving 100% of a Social Security check per month, let's say $2,000 per month, payroll, so what's constantly going to be contributing to the OSAI trust fund, that's going to be enough to cover about 75% of those payments. So if you are receiving starting in 2034, roughly speaking, if you are receiving 100% of your Social Security, let's say that's $2,000 a month, if no changes are made to legislation, then that paycheck's going to drop from $2,000 down to about $1,500 a month. Again, because people are still working. People are constantly contributing through payroll into the Social Security fund. We just no longer have those buffer assets because there was enough money coming in that we were able to invest. Now that we're having aging demographics, there's going to be more people taking Social Security than actually money coming in. So those benefits are going to reduce from 100% down to roughly 75% if no changes are made. But there are a number of changes that the federal government can make. A couple that come to mind, they can increase the retirement age from 65 and maybe gradually increase it to 65 and a half to 66. That could help. They can tax or tax Social Security up to any income threshold. So right now you only pay Social Security tax up to income of about $170,000. So you pay up until that level of income, you'll pay Social Security. For those individuals making $300,000, $400,000, $500,000 a year, just tax Social Security on the entire amount, not just up to that $170,000 income threshold. So those are a couple of sort of quick fixes that can actually really help to fill the gap and extend Social Security for the next several decades. But we do recognize that there does need to be some changes. It's just, obviously politically unpopular to say raise taxes, for example, or to cut spending. But I just wanted to provide some of that context on how Social Security actually works. You don't have to worry about your check going from 2,000 to zero. That's not going to happen. But there is the potential for that to be reduced slightly if no changes are made to legislation. Now, I want to spend a moment talking about interest rates. And this is a very timely discussion because the Federal Reserve is meeting right now, and Jerome Powell is probably talking right now to investors and reporters about how the Fed is thinking about the economy, the labor markets, as well as broader inflationary pressures. So this slide, looks at the federal funds rate, which is the Fed's primary tool. They adjust this in the overnight markets, short-term funding rates. Right now, the Fed is at, as of 2 o'clock today, they have Fed funds rate at 3 3/4, 3.75 to a 4% range. So they're gradually cutting rates. What we show also is what they expect to deliver over the next couple of years and what the markets expect the Fed to do over the next couple of years. So right now, the markets expected the Fed to cut rates today. They also expect the Fed to cut rates again at their December meeting, and they also expect to cut rates by another 0.5% over the course of next year. So we would expect to see that the Fed to cut interest rates to about a level of 3% by the end of 2026. Now, interestingly, I think there's this perception that because the Fed is cutting rates, that means all interest rates in the economy are going to be coming down. Mortgage rates, credit card APRs, auto loan rates, all those are going to be coming down. And that's not necessarily the case. You know, when we look at when the Fed was cutting rates in the fourth quarter of last year, September of 2024, when they started cutting rates, and they cut rates in September and December, what we actually saw happen was mortgage rates actually moved higher over the fourth quarter of 2024. Long-term interest rates moved higher over the fourth quarter of 2024, even though the Fed's cutting rates. So it's important to remember that the Fed, you know, there's maturities along we call it the yield curve. So there's a number of maturities that you can invest, right? When we say maturities, there's Treasury bills at the very, very front end. That's very tied to things like money market fund rates. So typically when you see the Fed cutting rates, you see your money market yields come down. You see the yields on CDs, certificates of deposit, come down. But those don't necessarily affect things like a 3-year auto loan, for an example. That's a different rate. That's a little bit further out on the yield curve. Mortgage rates, those are 30-year mortgage rates. So those are very, very long interest rates. So the Fed doesn't control rates across the entire curve or maturity spectrum. They control rates at the very, very front end. So I think that's an important distinction. We've actually, again, seen mortgage rates be a little bit volatile even while the Fed is cutting rates. But we think that mortgage rates will continue to hover right at around 6%. We think that we'll stick between 6 to 6.25%, roughly speaking, percent over the next several quarters. So for those looking for a sort of a reprieve in terms of rates coming down to sub 5%, I don't think that investors are really going to get that benefit. This obviously translates to continued challenges across housing affordability. So with mortgage rates above 6%, the median home price now sitting at about $450,000 here in the United States, housing affordability has become very, very challenging. I'll share with you a very interesting stat. In 1975, the average age of a home buyer was 33 years old. Anyone guess what the average age of a first-time home buyer is today? 55. It's right on the money. So you think about that dramatic shift, right, in terms of home price appreciation, now also on top of higher mortgage rates. Now, you know, folks here may very well remember when mortgage rates were at 10%, 10, maybe double-digit percent mortgage rates. But the median home price back then was $80,000, $90,000. So a very different sort of set of circumstances for a millennial home buyer, for an example, that's not only dealing with higher home prices and rising mortgage rates, but also straddled with things like student debt, which also makes it a lot more challenging as well. So there are a number of kind of challenges, you know, that we see, particularly as it pertains to the residential housing market and, you know, those millennial and Gen Z buyers in the market currently. Let me just pause there really quickly before we get into sort of the economics of all this. If there are any questions around the federal government deficits, debt levels, question in the back?
Yeah, I got a question from online. Mike says, does the analysis regarding income to Social Security account for the recent reduction in federal workforce, and importantly, the effect of AI on the broader workforce as human workers are displaced?
Great questions. So on the Sure. So the question's around, does the reduction in the overall federal workforce impact the analysis around Social Security and the trust fund? So at the corollary there being that if there's less people working and receiving a paycheck, that means there's less people paying into the system. The second question.
And importantly, the effect of
AI
on the broader workforce as human workers are displaced.
Yes. So I would say yes, the reduction in the federal workforce, by our estimates, we are factoring that into our forecast for when Social Security could potentially run out. But I will say it doesn't materially change the numbers or the forecast. The reality is When we think about the overall federal workforce, most of federal employees are at the state and local level. So if the federal workforce accounts for about 15% of the overall workforce, 13 of that 15% are employees at the state and local level. And we're not seeing mass layoffs at the state and local level. The other 2 to 3% are obviously coming under pressure given the layoffs that we've seen. But our numbers account for that. It's about 150,000 federal employees that have been directly impacted by federal layoffs. The U.S. has a workforce of around 150 million, so right at just about 1%, a little bit less than 1%. So not meaningfully impacting some of our forecasts in terms of the impact on overall Social Security. Now on AI, we are very bullish on AI. We're very optimistic on the promise that AI can deliver, particularly from a growth and economic activity standpoint. Now, a lot of times we spend, economists and strategists, we focus on consumption and government spending and the housing market. But if you look at the long term, economic growth is derived by two components: growth in your workforce, which is directly correlated to population growth, and productivity, your output per worker. And so some of the challenge that we're seeing in terms of the aging demographics here in the United States, and now being the hard line that the administration has taken towards immigration, the Congressional Budget Office actually projects that by 2035, the U.S. will see net negative population growth. And so where are we going to be? How are we going to get to a 2% economy or continue to be an economy that can grow by 2 to 3% when you have negative population growth? You need to get it from productivity. And we do think that artificial intelligence and generative AI is going to allow the broader workforce to become more efficient, more productive, and that is where we're going to generate a big piece of how we're going to continue to grow as an economy of 2 to 3%. Now, it's not enough. There's a great question asked a little bit earlier. It's not enough for companies to pay $20 a month and give everyone ChatGPT, right? That's not going to make our workforce more efficient. What is going to make our workforce more efficient are how companies and firms like New Capital are using AI as everyday part of their business. It's not just tech firms leveraging AI. I'll give you a few examples. John Deere, for an example, right? An industrial agriculture company. They're now leveraging GPU technologies in many of their industrial tractors that can fertilize the soil, kill the weeds, and plant new crops, all while the farmer is drinking his cup of coffee. That's productivity enhancing. When I speak to a lot of healthcare CIOs, particularly radiologists, they're now using AI imaging, the fact that AI has the capacity to look at hundreds of years of imaging across different organs and body parts. They're now using AI imaging to provide probabilistic estimates of whether a tumor has risk of becoming cancerous or not. Now the radiologists can work hand in hand, not so much on the diagnosis, but on fixing the problem and providing recommendations. These are examples of how companies and I think the broader economy are going to become more efficient and more productive, and that is how we're going to continue to be an economy that can grow 2 to 3% over the next 10 to 15 years. Question?
There's an argument to be made for science as one of the major foundations for economic growth, like how the search that gave us quantum mechanics started out as something very theoretical, and now it's the center of our technology, and we're kind of moving into an anti-scientific world or political context.
I very much believe that, I would agree with you. And the direct corollary is the spending on science. And so, the funding towards programs like NASA, exploration, deep sea exploration, things like that. Obviously that has direct, benefits towards medical services and medical sciences using more advanced MRI and CT scanning machines, et cetera, et cetera. All this has, those investments have cascading effects. So the direct spending itself acts as a boost towards economic growth, both from a government perspective, government spending, as well as in private sector spending as well. There are a number of funds that raise capital specifically for things like social sciences and investments in medical devices as well. But it is a risk, given the administration has taken the other side of this and has sought out ways to decrease funding in various areas of science. And I also think it should be worth mentioning that the focus on where these science dollars are going. Is it to set up a base on the moon? Is that the most productive sort of in terms of economic growth, and or should it be universal food distribution for those underserved communities? Things like that. So it is certainly something that we're thinking about, but I don't think it changes the trajectory of kind of longer run growth here in the U.S. Yes.
As AI increases efficiency and production over many companies, it's also producing a lot of huge layoffs of employees. What do you think the long-term effect of those unemployed people are going to be?
There's going to be some pain, no doubt about it. I've seen estimates as conservative as 1.5 million job losses driven by AI, up to 10 to 20 million job losses driven by AI. And unfortunately, a lot of those losses are likely to come from lower income individuals. You think about Amazon introducing robotics into a lot of their warehouses. That capital is accretive to Amazon's balance sheet at the expense of those warehouse workers. Companies like FedEx and UPS leveraging artificial intelligence to optimize routes and deliveries. Potentially the introduction of broader autonomous vehicles. Now those delivery drivers are out of a job. And what we're likely to see are those less skilled laborers and also those less educated jobs are going to be the ones that are felt the most from AI, at least that initial wave. But we also have to remember is that AI is likely going to create jobs as well. Companies like Deloitte, for an example, are hiring engineers, folks who can provide services on how to build out prompts in AI so that you all can become more efficient in what you do. Consultants that can look at different business models and supply chains and provide consultative advice on how to implement AI to make businesses more productive and more efficient. One of the interesting tidbits around the introduction of the ATM. Everyone thought when the ATM started to come through in the banking sector, it was going to be the death of the bank teller, right? We weren't going to need bank tellers anymore. But in fact, what we saw was as ATMs became more and more available throughout the economy, we actually saw an increase in hiring of overall bank tellers. Why? Because as people went to ATMs and realized, oh, this is great, I don't have to talk to somebody to get my cash, what are some of the other banking needs that I can ask about and that would require me to go in and talk to a bank teller? So we actually saw both an increase in ATMs established, but also an increase in hiring across bank tellers. So I think it remains to be seen the severity of job losses. It's going to vary across a number of different industries as well. But I think we also have to remember that AI, it's going to create jobs, and it is going to make things a lot more efficient and productive over time. And our view is that it's going to be a net positive for the economy over the next 10 to 15 years. Now let's talk about the conundrum facing the Federal Reserve right now, because they have two mandates: maximum employment and price stability. And what we're clearly seeing here on the labor market dynamics is this chart here just shows payroll growth. That's the net number of new jobs that are created in the economy every single month. And coming out of the pandemic, we saw a surge in overall job creation. Companies couldn't hire fast enough coming out of the pandemic. Now you can see that number has basically come to a standstill. Now, obviously, with the government shutdown, It's been very challenging to get a read on data as the Bureau of Labor Statistics is not able to publish these reports on a monthly frequency. But other measures of labor market data would suggest that job creation has been very, very slow. One of the things we've also noticed, partly driven by AI as well, is that introductory level jobs, those who are just graduating out of college, are finding it difficult to find work as well. So some challenges across entry level job creation. Then also, again, broader kind of slowing as CFOs are a little bit more hesitant about the broader economy and potential slowing in economic growth over the next couple of months. So this has led to very, very slow net job creation, and that poses a challenge for the Federal Reserve because they want an economy that is creating jobs. And so this allows the Fed to continue to cut rates in order to provide some degree of stimulus for the broader economy. Now on the next slide, the inflation side, they can cut rates because labor markets are weakening and they want to support labor markets, but inflation is not where they want it to be. The Fed targets 2% inflation, and right now inflation is running at about 3%. Not it's necessarily a bad thing. 1% difference is not necessarily meaningful, but it's where inflation may be headed. And the reality is, while higher tariffs are generating significantly more revenues for the federal government, at some point companies are going to push this higher costs onto the end consumer. And that could very well lead to more inflationary pressures over the next couple of months, and that keeps the Fed very worried. And so they don't want to cut rates down to zero like they did after the global financial crisis, after they did after the pandemic. But I think, given that both of these labor markets are weakening, but there's still some modest inflationary pressure, that perhaps keeps the Fed able to continue cutting rates, but they're not going to cut rates down to 0%. They're probably going to land the plane somewhere between 3 to 3.5%. That's our expectation by the end of 2026. Question?
Jordan, I'm hearing reports, and we're having experiences of recent college graduates having difficulty finding work. I've been contacted by several looking for work, and do we have a place for them to land? We're hearing it from some clients. Are you all seeing that at the bank? And isn't this worrisome that our well-educated young people may be getting a period here where they immediately are met with adversity in the job market?
Absolutely. So you could actually look at unemployment rates by age cohorts. And when you look at the unemployment rate for those 16 to 24 years old, they're actually looking at an unemployment rate roughly around 8%, and that number actually has been increasing over the last several readings. But again, the headline unemployment rate's at 4%, right? So our youth dealing with roughly double kind of the challenges in terms of finding labor. And it is a concern. It is something that we're watching for. I think what we have noticed is that there's continued demand for those who've graduated across engineering, those who have graduated across trade jobs. So those, we need more electricians, we need plumbers, we need bricklayers, we need welders. And so those, trade jobs, those graduate from trade communities are still getting jobs. Engineering, computer science, they're able to find jobs as well. And, I think this is a general soft patch. If I was graduating right now with an African-American studies major, I'd probably find a difficulty finding a job as well. But I do think this is a sort of a soft patch. I think this is kind of a 6 to 12 month kind of soft patch that we're sort of experiencing here. And I think you will start to see students be more thoughtful in terms of what they want to major in, going forward. The reality is AI is doing a lot of writing, for example, and so maybe there's going to see less folks wanting to embrace English as a major, for an example. So I think you will start to see broader economic dynamics shifting how we view broader education as well. And also layer on top just the cost of education becoming so much more expensive. There may be a renewed focus on more traditional trade professions. Yes.
So I don't know what age, if you have kids, what age they are, but what would you tell like high school students at this point that are going to go to college, that's their path? I mean, engineering is one. I'm hearing I've got one of those. But what else do you think would be a good future pick? Because I'm an attorney, and we're not able to hire some of the babies that are really talented because AI it's not closing down what I do, but it's closing down what we need from the young.
Yeah, even like paralegal work, for an example. AI has the potential to replace a lot of that document drafting and things like that.
So I'm just curious what you would counsel high school kids.
Sure. So I have two young ones, a 3-year-old and a 1-year-old. So they're way younger. They're not in high school. Totally different. We're worried about what elementary school they're going to. I would say jobs to engineering, computer science, consult. I still think computer science, consulting, so business and finance. What we do, particularly at the bank at J.P. Morgan, it's a people business. And I think you all find a lot of value being able to go into New Capital's office and talk to someone about your investments, about estate planning. And so I think, those are jobs that aren't going to go away. And I think AI is going to be more supplemental to what we do, not replacing the kind of work that we do. I continue to be a big proponent of trade jobs. And then, elsewhere, I also think there's a lack of healthcare jobs. There's continued to be a lack of healthcare jobs. So anyone pursuing a field in medicine, I think that is a great career path to explore as well. Question in the back?
That I keep reading about is that AI is taking away these first level jobs for the engineers and computer scientists coming out of college. They're like first level jobs for attorneys that paraprofessional. And so they need babysitters, so they have babysitting AI. But then in about 10 years, there's no one to fill the next level jobs because they haven't even experienced to let them run. Can you talk a little bit about that and how that might impact the economy?
Yeah, so that impact kind of on like that middle management, like over the next 10 years, because if we're not hiring a lot of the analysts and associates, so to speak. I'll be honest, we haven't given that a ton of thought specifically as it pertains to kind of that middle management level work. I think it is still reflective of the broader transition that we would expect to see, is that there are going to be some job losses, but there are also going to be jobs that'll be created as well. And so, I think it's really going to be about the shift. And the bigger concern that I have kind of falls back on education. Yes, millennials and Gen Z are the most well-educated in terms of the share of workers in these cohorts that have a bachelor degree or associate's degree or higher. But as we continue to mature in a more services-based economy that is heavily influenced by generative AI, we're likely going to need to see more and more people have a bachelor's, more and more people have an MBA, have a doctoral degree of some kind. And the challenge there is again kind of the cost of education, and is that affordable for many of these individuals? And so there's going to be a tug of war. There's going to be the benefits, that productivity that AI is deriving, but the potential impact on population and labor force growth, which is likely going to be challenged on a go-forward basis. But I think to your question, it is something that I think it is worth us looking more into. I want to be cognizant of time and make sure we're keeping everyone on schedule. So shifting globally, obviously the Federal Reserve is not the only central bank. There's the European Central Bank, the Bank of Japan. Those are the primary others that the Bank of England that we follow. This is also just looking at those rates that we talked about. So that gray line is just the federal funds rate that we just took a look at. You can see the forecast does expect the Fed to kind of get rates down to about 3%. And when we look globally, we are expecting to see other central banks kind of continue to ease as well. The Bank of England is expected to continue easing as well as the European Central Bank. The outlier is clearly the Bank of Japan. The Bank of Japan is going in the opposite direction in terms of gradually raising interest rates. I think this is actually a good thing because they've experimented with negative interest rates longer than any other central bank has. And they haven't seen any fruits of that labor. They haven't generated GDP growth. They haven't generated inflation, even giving interest rates were negative, right? So I think this is actually a welcome sort of improvement from a global perspective. And if we maybe move forward one more to talk about how all this translates to the dollar. So the dollar tends to be driven by a number of different variables. And it's very hard to forecast currency movements in the short term, but over the longer term, you tend to see the dollar move by what we call the twin deficits, the trade deficit and the budget deficit. And then the other kind of third component is interest rate differentials. So let me first talk about the trade deficit. When you run a trade deficit, that means you buy more goods in the global economy than you sell. That means you're flooding the world with dollars as you're using those dollars to buy more goods, and that tends to put downward pressure on the value of the dollar. You can see our trade deficit up to the right-hand side. On average, we've continued to run a trade deficit of right around 4%. So we're continuing to flood the world with dollars. And that's likely to continue on a go-forward basis. When we think about the budget deficit, we talked about that, right? So deficits, we continue to spend more than we bring in. And the issue there is that global investors own about a third of the Treasury market. So as a large share of our deficit spending goes towards interest payments, you have to pay interest on all these increasing Treasury bonds that we issue. Some of those interest payments are dollars that are going abroad and going overseas. So you're also flooding the world with more additional dollars, and that puts downward pressure on the value of the dollar over the long term. And then you've got interest rate differentials. What this essentially means is, what's the interest rate that I can get on dollar-denominated assets versus a European asset or a Japanese asset? And right now, because the Federal Reserve is cutting interest rates, they're lowering the level of yield or income that you're able to get on dollar-denominated assets. And that tends to put, again, some downward pressure on the value of the dollar. So you've seen the dollar sell off 10% so far this year. It's a very rapid correction that we've seen in the dollar. And we would expect, and kind of see this, which is quite interesting, this chart here, this looks at the dollar over cycles. And what you can see here is that the dollar tends to behave in very long-term cycles. You tend to see, right, 5 years of dollar appreciation followed by 7 years of dollar depreciation. And so these long cycles tend to play out. And just the dollar had peaked in 2022 and has since come down. And we do think that the dollar is going to spend the next 3 to 4 years coming down. And that informs how we think about broader portfolio and asset allocation. So in that environment, you may look to invest in international assets. As the dollar comes down, that tends to bode well as a U.S. investor investing in global assets. And then really just quickly, before we open things back up for some questions, just in terms of the broader interest rates, I know there's a lot of numbers on this page. I don't want to spend too much time on the table there. But as we think about the opportunity set for investors, particularly saving and investing in bonds, right, high quality bonds, the dynamic has really shifted. So the mountain chart on the right-hand side, this shows the share of U.S. debt, developed market debt, and emerging market debt. So the trillions and trillions of global debt that's sitting out there. 30 years ago, the U.S. was the only game in town, more or less. It accounted for about 60% of the global bond market. Now that number is down to south of 40, and we've seen a lot of growth actually coming from emerging market debts. So debts in things like the periphery Europe, for an example, or in South America. And so there's just a bigger pond to fish in. And so we quite like the opportunity set in a backdrop where the dollar is weakening potentially over the next 3 to 5 years. Global governments outside the U.S., particularly in Europe, tend to be a little bit more fiscally conservative, and that tends to bode well for the interest rate outlook. So, we think there are opportunities growing from a global perspective, not just on the equity side, but also on the fixed income side of things as well. So with that, let me just pause there and see if there are any questions. I think that's my last page on the slide. Feel free to follow me on LinkedIn. feel free to have access to the Guide to the Markets. My LinkedIn page is where I post a lot of my blogs and my research. So you'll have access to that. And also where we try to answer a lot of the questions that we're getting from clients and advisors. So we just recently published an article on Tricolor and First Brands, their default, and a lot of concerns that we might be seeing in areas like private credit. So we have to share some thoughts there. And obviously other areas, gold, right? What do we expect from gold given the impressive rally that we've seen so far? So a great sort of platform to access our research. Yes, question?
My question, Jordan's about the yield curve. We have almost an upward sloping yield curve,
Mm-hmm.
but we still have this little downward belly around 2 to 3 years. Is that going to get addressed by the Fed dropping short-term interest rates, or is something else going to adjust it? And then maybe you might comment as well on what does it mean for the possibility of a recession if we have this upward sloping yield curve for the most part?
Yep. So the questions around the shape of the yield curve. Will the Fed cuts straighten out or continue to steepen the curve, and what are the implications that could have on the outlook for a recession? So right now you kind of have a bit of a spoon going on with the yield curve. So you've got the Fed funds rate, which as we talked about, that the Fed controls. It's now at 3.75 to 4%. But when we think about, the 1-year rate or the 2-year rate, a lot of that is still very much heavily influenced by the Fed funds. If you look at a 2-year Treasury bond, that is effectively what's the average Fed funds rates, very short-term rate, going to be over the next 2 years. And if the Fed is cutting interest rates, then the 2 years should price in those expected rate cuts. And so that's why while the Fed is cutting rates, and the market expects the Fed to continue to cut rates, you kind of have this little bit of a spoon or dip at the front end of the curve, and then things start to steepen out as very long-term interest rates are more heavily influenced by long-run inflation expectations, long-run growth expectations. So as the Fed starts to continues to cut rates, we think that kind of belly stays put, doesn't really move too much. The 1-2-year bond doesn't really move too much. But your money market, Treasury bill, and certificate of deposit rates will come down as the Fed is cutting rates in real time. That will continue to what we call steepen out the yield curve. And we very much anticipate that the yield curve will continue to steepen out, i.e. short rates coming down more than long-term interest rates. Now, as it pertains to a recession, the reason why we care about the yield curve is because it has been a pretty good barometer in predicting recessions. Now, times are good or normal when the yield curve is positively sloped and we're heading to that environment. But just a couple of years ago, the yield curve was heavily inverted. So meaning that short-term interest rates were a lot higher than long-term interest rates. And when you tend to see that play out, that's the market saying, well, hang on, the Fed is conducting monetary policy that is way too restrictive on economic growth and activity. And so short rates end up being higher than long-term rates. Again, long-term rates being heavily influenced by growth and inflation. So if the Fed is too tight, bad for the economy. When the Fed is easing up on policy, that tends to be good for the economy, and you see the curve steepen out. So we are not forecasting a recession. A steeper curve driven by the Fed easing up on policy rates at the front end tends to be supportive for economic growth. It tends to be supportive on things like credit spreads, keeping credit spreads pretty tight. And it also tends to be pretty supportive for risk assets, equity markets. And so we are actually pretty bullish on the market. We recognize that AI continues to drive equity markets higher, but we think other components of the market that are more tethered towards a pickup in growth, things like financials, industrials, utilities is sort of another play on the AI trade. You need to have a utility provider and pipeline company to deliver the energy from the data centers to the city centers. So these are areas of the market that we think could very well be supported in an environment where the Fed is cutting rates and supporting growth.
Any other questions for Jordan Jackson? Thank you so much.
Thank you.